Well, as Nigel said, thank you all for coming tonight. I know you're all busy, so it's really good to get the chance to talk to you. I'm going to try and not bore you to death too much about tax. It's what I'm here to talk about, so I may well just skip over a few slides. We're going to look at record keeping. We're going to look at common expenses and how you can treat them, and whether you might be better off with any properties you've got, looking at the sole trader option or limited company option. And I know with the changes to legislation at the moment, lots of people are starting to think about a limited company option. On to the really exciting bit of record keeping to start with. Keeping your records is essential. I've been with a client today with HMRC, very few records. So he's going to get stung for tax. It's going to be a very big bill, and this is going back to 2004 for some of this stuff. So the assessment is going to hurt this chap a lot, unfortunately. He's not deliberately gone and done anything wrong, but he just hasn't maintained all his records. And they're at the end of each tax year to the 5th of April. So what we've got, and I am now trying to deliberately bring in a bit of selling to you, so I don't apologise for that. I've just invested in an app called Receipt Bank, and it means you can throw away your receipts. If you were to use it, you take a picture on your phone, straight through the Receipt Bank app. Your invoice is then sent straight into the cloud. You can see it at any time, I can see it at any time, and the best thing is the app actually reads it. We should get to that. I know you can't see the detail on there. I was on a client visit, I took a picture of that on my phone, it was read, the system knows it's from Moto, it knows what the VAT is, it knows the date, and it's a very, very intuitive and great piece of kit. It's really easy to use. So if anyone's interested in talking about that afterwards, please do come along. The other good thing is, Receipt Bank will talk to QuickBooks, which is the world's most popular piece of bookkeeping software, but it will also talk to Sage, it'll talk to Xero, it'll talk to anything that you need it to. It talks to every major bookkeeping package. And now on to the more exciting tax bit. Keep your records separate. Different types of property have different tax treatments. Furnished holiday lettings, basic rental properties, overseas properties. You need to keep everything separate. You can't just put it all together. And the last one is properties let rent-free or less than market rate. And that might be if you've got a son or daughter at university, you've bought a flat for them to go in, part of it's rented out to their friends at a sensible price, they stay there for free. It's not as simple as just saying, well, that's my income, because you're giving some income away. That's how tax would view that. Again, regarding income, we should always keep your records showing the gross amount you've taken for a property and then take away the costs. Don't simply say, well, I made £500, I'll just put that in my tax return. You won't get away with it. And deposits, as you all know, it's not your money, it's your tenant's money, unless you've got a right to spend it when they've done some damage at the end of the lease. This is interesting for people where you've got properties. You may have one high rate taxpayer in a relationship, one who isn't. You have the property 50-50, unless you make an election to move it. Now, if you simply say, oh, my husband pays tax at 20%, I pay tax at 45%, we'll put all the income onto him, won't work. It'll be looked at as settlement rules by HMRC. So what you actually need to do is move the property ownership over to the party at that stage. But that's not that simple. I've known of people then getting divorced, and suddenly someone's walked away with a property that they might not have paid for. Common expenses. Basically, any expense that you have has to be incurred strictly for the business. You can't just put a little bit of a cost in there, or you can't incur a bit of a cost and put it all through. It's got to be tied down to the actual property you were talking about. This, I'm just going to skip over here, apart from the first one. If you've any genuine expenses incurred 7 years before you start to trade, we can still put that through for you. But the chances of you actually having property before you start to get any rental income for up to 7 years are fairly slim. Legal fees?
What about buying a property? Would that be classified as an expense? Solicitors' costs?
Not an expense for rental income. Perfect slide. It's a capital expense, so that would go against your capital gain when you eventually dispose of the property. Well prompted. Mortgage interest. I'm sure many of you know that the rules around mortgage interest are changing at the moment. the government's clawing back. So by 2020, yes, 2020, you're only going to be able to get 20% tax relief on residential mortgages for residential property. And I'm sure that's going to impact on a lot of people when it happens. Life insurance, even though your mortgage provider may insist on you having a policy, it's not tax deductible because it's not viewed as being something which is wholly and exclusively for the property. And I can give you all the detail later. You're taking notes way too quick. Travel, the rules around travel have changed, but the easiest way of doing your travel now is estimate the number of times you've gone to a property, work out the mileage, and up to your first 10,000 miles, you can claim 45 pence a mile. Rather than worrying about keeping receipts, introducing a vehicle into your books, it's a lot simpler way. Anything over 10,000 miles, if you've got local property, you're not going to hit that, but you still get 25 pence a mile as an allowable deduction at that point. Repairs, we all know what a repair is. I'm not even going to talk through that one. Capital expenditure is slightly different, and this again goes into building up the value of the asset. Anything that you've done which physically changes the property other than a lick of paint or a bit of electrical work. Now, we used to get the wear and tear allowance on property, on items in there. That's gone away now. Some of you may be aware of that from having properties in the past. You can't claim for the initial purchase of an item, but you can now claim for the replacement of it, which is a slightly strange way of doing it, but who are we to argue with HMRC? I've talked already about the restrictions to mortgage interest, the way it's being clawed back. This is the first year the allowance has been withdrawn slightly. Next year it increases, it increases, it increases until we're down to the 20% element I talked about earlier on.